morning, everyone. Welcome to Monday. Welcome to Monday Minutes. The shot across the bow. Last week, St. Louis Fed President Bullard talking about a Fed funds rate potentially between 5 and 7%, saying that he thought 5 to 5.25 was actually a floor. Now, in general, markets have moved a lot since the CPI and PPI print. Very anxious for any type of good news amidst a year of extreme repricing. And we've seen a lot going on in markets really since that CPI print, some of the broader trends that we've seen throughout 2022. And we want to talk about a few themes in the marketplace right now. We're getting a lot of questions on the yield curve. This is really a favorite of ours for those that do follow us. Understand and know that we have favored not only flattening since 2021, but the inversion trade of 2022. So now we're seeing the extremes in that yield curve, whether you call it 3-month, 10-year, whether you look at Fed funds soon to the 10-year, the Fed's measure of 3-month to 18-month forward 3-month. You look at 2s, 10s. We actually posted over the weekend, we look at 2s, 5s a lot, that part of the curve, almost as inverted as the 2s, 10s curve. Very impressive. The Fed talks about the pain in the marketplace, the economy. A lot of foreign entities favor that part of the curve. So we're watching that 2s, 5s curve very closely here. But when you look at it very categorically, you look at what the Fed is saying and you look at the yield curve, we have a tale of two different curves here. Out the curve, real yields have gone up. We've certainly seen interest in 10-year yields in and around 4%, to call it 4.33, which was the peak. Real yields now much higher. And then at the very short end, the Fed is saying we need to see pain in the economy. They continue to fight inflation here with the notion that interest rates are going to continue to go up. So short term, where you have a central bank that is targeting the economy, they are targeting growth very, very specifically here. There's really nowhere for this yield curve to go than doing what it's doing right now. And we'll see where we get to in terms of extremes. But certainly right now, we're seeing some of the most extreme levels that we've seen in decades. The other thing, too, is this dialogue with the Fed now as they talk about downshifting, which we've certainly favored. How do they downshift in the market, move to 50, potentially 25 basis points? How is that going to be received in the marketplace? That's part of the biggest challenge right now. So if you look at financial conditions, which we know the Fed looks at very, very closely, if you look at what financial conditions have done since that CPI print, this trajectory now, the market's hungry for any piece of good news. They've loosened a lot. We've seen a reversal in the dollar, certainly credit spreads, equities. You look at what real interest rates have done. That's going to be part of the challenge for the Fed going forward as they do start to downshift into 2023 and potentially at some point pause and see how these interest rate increases are flowing through to the marketplace. The other thing is inflation expectations. If you look at market-based inflation expectations across the board, they've come down a lot. If you look at the TIPS market, we're seeing break-even rates now with two handles across the board. If you look at the 5-year forward, 5-year break-even rate, we're seeing that now back down close to the Fed's target. So the Fed has been very effective with regard to inflation expectations. We know it's a very, very important component in terms of how they look at spot inflation, what consumers are saying they think inflation will be in the future, and how that folds back to impacting what we're seeing in current inflation levels. So it's going to be very important for the Fed as they do start to downshift here to maintain control of inflation expectations. And then lastly, the financial stability issue, the liquidity issue that we're seeing in the Treasury market right now is being spoken about. It's something that really from the outset of 2022, we spoke fairly aggressively about as we saw the Fed lift off in March and at the same time embark on letting the balance sheet run off. Who is the marginal buyer in the U.S. Treasury market as the biggest buyer backs away? And we also know at the same time, given the currency moves that we've seen in 2022, we've seen foreign central banks back away at the same time. So those liquidity issues that we're seeing in the marketplace right now are being spoken about very vocally by members of the Fed, certainly by Secretary Yellen coming from the Treasury Department. How that evolves, how that develops, we think will be very important as we move into 2023. On the ground this week, we do have some data. Obviously, it's a shortened week here. We think in terms of economic releases or a touch point for this week, certainly the FOMC minutes this Wednesday before the Thanksgiving holiday. Wishing everyone a great and wonderful Thanksgiving. Despite a very, very challenging year, there's always a reason to be thankful in this wonderful country that we live in. And I'm wishing everyone a great holiday week this week. I'm Greg Faranello. I'm head of U.S. rates for AmeriVet Securities.